Good morning, everybody, and welcome to this Q1 Hafnia presentation, and welcome to the CEO, Michael Skov. My name is Ture Østergaard, I'm with HCA, and I'll be today's moderator. We will take approximately 30 minutes, go through the Q1, and if you have any question, please put them on the chat. I'll control that and let them in as we go, and of course, I'll ask them when it's appropriate. But welcome, Michael.
Thank you.
And I'll control the slides, so I know where you are. But I think we'll just kick off with a brief introduction, as always, to Hafnia, and then go into Q1, and then perhaps a bit on the fundamentals of the business as we speak, and then we can take questions in the end. Welcome.
Thank you. Sounds good. Yes, and just to do one of these brief introductions to Hafnia, when you look at this slide, so basically Hafnia is all about transportation of refined oil, and we do that in product tankers, which is the tanker vessels that we have throughout the entire fleet. As you can see, top left, we financially control 124 ships, but in addition to that, we also have another 100 vessels that we manage for other owners. So altogether, we commercially control around 230 vessels worldwide. Our NAV at the end of Q1 2023 was $3.4 billion. The average age, which is also a very important part of the business strategy, was 7.7 years. And when you look at the average age, you should compare it to the average age of the entire product tanker fleet, which is around 11 years. So 7.7 indicates that we do have one of the most modern fleets in the product tanker sector overall. Finally, a quick comment on that we are listed on Oslo Stock Exchange under the ticker Hafnia. If we move on a little bit to the right side, just to give you a few highlights of what we have been focusing on in Hafnia, and which we believe are some of the key pillars to the fact that we've managed to build this company from zero in 2011 to the largest global product tanker company today in 2023. So top right, one of the first issues is really what we call active management. And that's basically linking up to what kind of activities, what kind of acquisitions, what kind of strategic initiatives have we done over the years to build the business and be ready to harvest when markets are high, as what we are seeing today. So I think Hafnia's DNA is very much about having done M&A transactions, new build, separate acquisitions of different fleets, transactions that involve normal settlement in cash, but also settlement in shares. So I think if you look at the history of Hafnia, it's a magnitude of different structures and scenarios that brought us to where we are today. As I mentioned, sorry, go on.
Yeah, no problem. I just want to add, Michael, that your stock value actually now is approaching almost 30 billion Norwegian kroner. So it's up 7% this year. So it's actually in Norwegian market, it's a quite big player.
Exactly. So we are now amongst the top 25 on the Oslo Stock Exchange overall. So it's for sure it has been for this year and last year it's been a very strong progress in terms of creating more liquidity in the shares and more trading, which also is part of the reason why the share price has done well.
Perfect. Should we go into the Q1?
Yes. So basically, as you can see on the slide, the Q1 was a very, very strong quarter for us. It was significantly stronger than last year's first quarter, slightly weaker than Q3 and Q4 last year. But overall, I have to say that we kind of is continuing where we left last year. So, with the result of $256 million in net profit, that's a significant result and probably one of the highest quality results that we've seen over years. The interesting part about our result, I think, is also to indicate that we now have a strong dividend policy which focuses on our net loan to value situation versus how much we pay out. So the lesser debt, net LTV that we have, the more we will pay out in dividend. So we're now paying out 60% for this quarter in dividend, and we are at the moment very close to the next threshold, which is 30% net LTV. If we come below that, the payout and dividend will be 70%.
Cool. Yeah, I mean, this is more slides about Q1, and I don't know if there's anything you want to add. This was the brief overview.
I think in general, what I would like to say about the financials is that the market we're in now, and if you look back the last 12 months, where we've had very strong earnings, is that you will continue to see some differentiation between the various quarters. So we have weak quarters, we have strong quarters. So we're not in a market where seasonality has disappeared. So as an investor, I think it's important to still be aware that you are going to see, slow marketing, Q2, maybe a bit in Q3 versus Q4 and Q1. So it's a seasonality that will persist, but in our view, it will persist with a very, very high floor compared to what we've seen earlier years. But you are going to see markets continue to go a little bit up and down. So it's not going to be a steep curve just going upwards. That's not the way the market will work.
And can I just ask about your balance sheet? Because obviously we know that the payout ratios goes up to 70% if you come down below a certain threshold, 30% on LTV. But the net debt or the debt, so how do you view this in an environment where it's getting more costly the interest rates are going up worldwide? And I guess one of the key reasons when you invest in new ships is also the interest rates level. How do you see this impacting your sort of way of managing the company?
Yeah, so part of managing the balance sheet at the moment is also that we do pay down debt, and our view is that we do want to have much lower leverage. So we're not really looking at today's valuation when we look at where we want to be in the future. We're looking at a mid-cycle situation and saying we'd like to be, at least below 40% levered as we hit like a mid-cycle level on asset valuation. But at least on the interest part, I mean, we have about 67% covered already of our interest rate exposure. So we have been pretty prudent in securing that this is not running away from us. I do think that in this high interest environment, that going out and buying assets, in particular buying new builds with forward delivery, is expensive, and that's also what we are seeing at the moment. And in our view, it's part of the reason why you haven't seen so much activity on new builds in general, is that higher finance cost, forward delivery, and very high prices driven by the inflationary period we've just been through.
Cool. So yeah, I don't know. This is the TCE rates per segment. Are there anything here you want to highlight for Q1 that you think has? I mean, obviously the rate level is on a completely different planet than it was a year ago, but I don't know if you have any comments to that.
Well, I think first comment to this slide is really, if you just look at the lower part of the slide, is that just to illustrate that we do have a strong focus on our cost structure, as you can see in terms of Hafnia versus the benchmark and the peer group. So for us, the whole cost side, whether it's being OPEX or SG&A, is by far the lowest in our sector. So there's a strong focus on that. No, I think on TCEs, actually, what you're going to realize over time is that the different sizes of product tankers in some form and shape correlate. So you're not going to have, for instance, LR2s making $100,000 per day, and then MR vessels making $20,000 per day. One of them will have to give, because ultimately the product tanker market has a lot of flexibility, and if freight is too expensive in one sector, one size, the cargoes will just get broken up into smaller pieces, and they'll go down to, for instance, medium range type of ships. So over time, it correlates. So, I think you're going to see that the differentiation between the various sizes are going to be relatively stable over time.
Okay, if you have any questions to this Q1, then let us know now. And then your coverage, it's always interesting to see, because we take it as a measure for how you see the world, depending on your coverage rates. So maybe you can take us through what your thinking is right now in terms of the fleet.
Yeah, so our thinking has been that we don't have a lot of long-term coverage. So the coverage you see here is mainly really driven by the spot market and some of the fixtures you can do like 1 or 2, 3 months ahead, but we don't have a lot of coverage that goes way out. So once you go out, say 12 months, the average coverage rate for us will be about 10%. We do, however, when we are in these strong markets, look at how we can improve on coverage situations, but that would have to be for longer periods. So our focus is really 12 months, 6 to 12 months. We prefer to play the spot market. If there's a very, very high number obtainable that you can log in for 3 years, then we'll definitely look at it. So it's more the longer term at high levels that will be our focus area when we talk about coverage.
Cool. This is always an interesting slide about your earnings for 2023. And I must admit, I have to read it twice before I understood the Q2 covered rates and then the year to date. But the overall message here is that you have an EBITDA of around 1.2 billion.
Yeah.
And that's, in contrast to a market cap of 3 billion. So,
correct.
So that I think that's the thing to understand. And this prompts my question: is this because, assuming that's a low PE, that the market doesn't think that this is a long-lasting situation? Is that your sense when you talk to investors worldwide?
Yes, I think it's a combination of that, and then I think it's a combination of historical focus of NAV and where shipping companies should trade around NAV. But for sure, I think for a long time, particularly after the war in Ukraine started, there was a lot of concern about whether this was just being a short-term high freight rate environment that would probably end if there was a ceasefire situation. But what we are sensing now is that people are beginning to buy into, just as we are, that even in a scenario where the war ends, and hopefully that happens soon, it's not going to change the product flow of Russian oil in general. So we believe that there's a structural change that has been happening now, is that Europe are making themselves independent of Russian oil. So the trading patterns we are seeing today that originated out of the Russian sanctions, we all believe are here to stay for a long time. So I think that part is becoming, I think, at least from the feedback we get, most investors agree with us on that. Then I think the second part, and that's it's an understandable focus area, is that every time you've seen high freight rates over the years, you've always seen ship owners going out and build a lot of ships and thereby ruining the market shortly thereafter. So this was a prevention from having valuation based on 6, 7, 8 times multiples, because basically people thought in 3 years' time it's all going to be over because you built too many ships.
Yeah.
And this time around, these things are very different. So the reason why we think this market has more length is that all the order books are filled up with gas carriers, container ships, etc. So even if we want to build more product tankers, not only are we going to have to pay the highest prices ever seen in history of a new built product tanker, but it also only delivers in end 2025, early 2026. So it's so far out, which I've never seen in all the 35 years I've been in this. I've never seen that gap between the time you order a ship until you get it. So there's no link to the current spot situation that you can use for a new build order.
Okay, cool. But we already started this discussion, Michael, about the industry outlook and so on. I find it perhaps not so much this one, but you have a slide here where you talk about the world. Sorry for jumping, but the inventories. I just want to show you one. Sorry for that. This one, if we could start there, because that's I think the starting point of everything, and that's the demand for oil. And what you are saying is that this will peak. Demand for oil worldwide is going up.
Correct.
And to historic high levels. And that's perhaps where this gets interesting, because there's a difference between how the market perceives your stock and what's actually happening on the demand side. Do you understand my question? I think that's the difficult thing to reconcile as an investor here, that you on the one hand side have a huge demand uptick on the oil side, but yet we don't only pay 3 times PE for your stock.
Yeah, correct. And I think a lot of this also has to do with the fact that if we go back even 2 years, I think there was a very strong feeling that we were in the middle of a shift from fossil fuels to renewables. And I think there was so much discussion and debate around it that even in our industry, not just for our investors, but also for ship owners, there was a concern as to where are we going with this? Is this happening tomorrow type of thing? And I think what has caught a lot of people by surprise is that we've come out of COVID and we are almost instantly back to the oil demand that we saw before. And not only that, we are now seeing that it's going up, as you say, this year, and will probably peak at the end of the year at 103 billion barrels per day, which is basically the highest we've ever seen. So, I think this is a combination of nobody having invested in building ships around fossil fuel transportation in the expectation that maybe we're going to have an alternative very soon. And now we have the opposite situation, is that we've been through an energy crisis that shows that we actually need these type of products for many, many years to come. So I think everyone has been caught out by this, and I think that's part of the sentiment that we've seen, where people have been slightly, concerned for a while, and now I think we're kind of back into the flow where it's becoming more and more obvious that oil demand continues to go up, and even if it stabilizes, at least in our sector, it's impossible to build enough new ships to replace all the ships that are now being scrapped and all the ships that we're going to need for the probably next 5 to 6, 7, 8 years at least.
Yeah, because that's this one. And to be honest, if you read the papers, the shipping news and stuff, you have a feeling that the contracting is picking up slightly. So maybe just take us through how you see this, because on containers it's gone crazy, 30% of the order book. And I have yet an impression that there are being small contractions in the tanker market, but maybe that's a good starting point for discussion on the supply.
Yeah, so you're right. So there has been ordered, particularly actually in the LR2 segment. We've seen, I think up to 40 vessels being ordered. And some of them has been ordered with new propulsion, which means that they in the future can also burn other things than fossil fuels, LNG, for instance. So yeah, of course, you're always going to see some ordering as you go along. I think people have capital to spend. That's an individual decision. What you're not seeing is a landslide of ordering where everyone thinks it's a great idea to go out. So I think we also need to put it in perspective. The ordering we're seeing at the moment is absolutely insignificant. And if you compare it to the container side, because I think this is also an important point too, the container business will continue as the same business they are today. The only thing they have to change is what they burn on their engine. They're still going to be transporting containers. There's no difference. They can do the same calculation on lifetime expectancy of the ship, etc. If you build a product tanker, one thing is you build it so that the engine can burn other things than fossil fuels, LNG or methanol, whatever, going forward. But if you're going to work on the assumption financially that this asset is going to last for 25 years, that will certainly bring up a lot of debate. Is there 25 years out there of active oil transportation, or should you cut that down to maybe 20 years or 15 years? So I think for a product tanker owner, it's not that easy a decision to make at the highest market ever, because you have to factor in that the ship you order, delivery in 2026, will probably not have 25 years of lifetime, may only have 15. So that makes your financials even more complex and difficult to justify.
So you're saying that the depreciation should be 20 years instead of 30. That's basically what.
Instead of 25, right? Yeah, maybe even less, depending on how you look at it. But yes, definitely.
So just to be clear, the product tanker order book, since we were together last time, has picked up by 8% to 8% of the total fleet. Is that correct? Delivered over time.
Correct. That's right.
Okay. And the demand side, you're forecasting to an annual 3 to 4%. Is that a fair assumption?
Yeah.
Yeah. Okay. And you're saying that if you go out now, press the button and hire or contract a new ship, you will get it in 26. Is that how you should see it?
That's right. Yeah.
And that ordering, who has done that? Is it big companies? Is it Russian companies? Or is it broadly distributed?
It's broadly distributed. It's all kind of different smaller owners, I would say, in general. I mean, you have not seen for instance, a lot of stock listed companies going out and ordering a lot of ships in our sector now.
Okay, cool. So what can go wrong, Michael? Because you have the demand side, which is clearly working for you. China is coming up. We have a world depression somehow. Or I don't know, recession is, but something like it. So that will probably improve rather than go down. That's the demand side, and then you have the supply side with 8% total. So, as an investor, where can it go wrong? What should I watch out for?
You should probably also just add to those when you talk about 8% order book overall is that we are now approaching, by 2026 and onwards, probably the highest scrapping age we've ever seen in our sector, because most of the ships were built from 2004 to 2010 in our sector. They all going to come off for scrapping. So that even the 8% will be, not even enough to cover all the ships that disappear. So going back to a question, I think the obvious answer is that geopolitical events that in a way turns around, if you like, global trade, is something that we obviously see as a risk and something we need to relate to. It's not for shipping alone, so that will apply to everyone. But of course, a China-Taiwan situation that, for instance, accelerates would be something, and new sanctions would not be great for us. But it's really those macroeconomic issues and geopolitical issues that we see as the critical factors. We don't see any sector-specific things now that will change fundamentally that we are in a strong market for a long time. So a geopolitical macroeconomic event that reduces, like COVID-19, oil demand dramatically overnight, obviously is part of what we have to take in as a risk, but that's kind of it.
Okay. I think there will be many people who are sorry for. I'm trying to find the Russian slide you have, because I actually think that's also worth explaining. We've talked about it several times before, that this Russian tanker market is dark and nobody knows what's going on. Maybe you can just share your view on this.
Yeah. Well, you can say we do know what is going on because we are actually able to track it. So what we have seen is that there's a lot of new companies that have arisen around this and have been buying a lot of ships. If you look at this slide on top, you can see that there's been a total of 292 ships that we have seen loaded in Russia. If you go bottom left, you can see if we convert those into MR equivalent, i.e. medium range product tankers equivalent, just to have something to compare with, it's the equivalent of 323 MR vessels that has been employed in the Russian trade. So it's quite substantial what we are seeing, and you can see by type and by age that these are primarily older ships, and it's a common view now that the majority of these vessels will never be able to come back into normal trade again after a potential end of sanctions and end of war.
Okay, so and that means BP would never ever take them into their fleet again, or somebody. It's over. They are
absolutely. So of course, there can maybe be a few here and there, but in general terms, these ships represent now a part of our overall fleet that particular oil companies and others do not want to touch afterwards. And in addition, unfortunately, and this is something that's bad for all of us, is that there's a lot of issues around maintenance. There's a lot of issues around that they don't have insurance. So we are beginning to see a few cases where small collisions and other accidents actually have quite a high price for all of us, basically, because there's no coverage. And that means that basically it's up to the rest of the world to, in a way, save and deal with these things. So that is another reason why we can always say 100% that these ships are not going to come back to any normal trade afterwards.
Just a question, Michael. Is there anything that has caught you by surprise in terms of how this Russian situation has played out in the tanker market since the sort of ban in February?
I think we're probably a little bit surprised actually, by the size of this dark fleet. That's probably fair to say. We had not expected that many would actually engage in a trade that is technically fully sanctioned. That probably took us by surprise, that it was possible to build so many ships so quickly in systems that are able to trade, despite the fact that the world is trying to sanction that type of business. But other than that, no. I mean, I think we're still not seeing, we think, the full effect of import into Europe. So one thing is the export of Russian oil that used to go to Europe, that's now going to South America, North and West Africa, the Middle East, and the Mediterranean Sea. But we have not fully seen the effect of European import, because Europe imported so much oil in the fourth quarter to have inventories high before the sanctions, that we're only now seeing inventories coming down to levels where they're going to start to import. So we still think that we have more ton mile, longer transportation of diesel oil, etc., coming from the Far East and Middle East going into Europe. So that will improve on the market conditions as well.
Cool. Is there any questions on this sort of balance between demand and supply? And then then please put them. Michael, I think that we've been through a lot of the main points here. Is there anything you want to share from these things? I think this is about the future, the near-term future for Hafnia.
I think so. The strategy for us is that we acquired so many vessels by the end of 2021, early 2022, that the focus is really for us about returning capital to shareholders. We're not going to run out and buy, 10 ships here and there, new build. It makes no sense. We have invested a lot, so it's more about harvesting. And then what we do is we keep on keeping an eye on the energy transition and what it requires of new transportation. So we're already involved in a couple of projects where we will be sourcing transportation, for instance, for ammonia, and for the future, I think we're going to have at least a handful of vessels that will be transporting ammonia. So that's just to show that we will be monitoring when and if there are attractive investment opportunities that will set Hafnia on a course that will take us towards 2050, and slowly but surely make sure that we have an existing business, but also a future business that is more towards the renewable side.
Cool. That's your team.
Yeah.
Michael, thank you very much. It was a pleasure talking to you. And thank you very much for you attending. If you have any more questions, then you go to our webpage and you can find anything you want. Otherwise, I'm sure you are available for questions, Michael.
Absolutely.
Thank you very much. See you
Thank you.
another time. Thank you.